Welcome to Breaking News to Trading Moves. Today we're looking at a market situation really driven by a key crypto event. Bitcoin pushing past $118,000 as what traders call Uptober kicks off.
Yeah, and our goal here is to kind of look beyond just that big number.
Yeah.
We want to synthesize the market implications.
Yeah.
Who stands to gain from this, who might face some pressure based on the price move itself, but also the broader economic picture. This should help you understand the immediate flow-through effects across different areas.
Okay, let's start there then. What's actually driving this move? Bitcoin hitting $118,000. What's behind that initial push?
Well, there are really two main factors at play here. First, you've got that Q4 seasonality in crypto, the whole Uptober thing, which, often brings in fresh momentum. But maybe more importantly, the macro backdrop, a softer U.S. dollar. That's key.
Right, the dollar weakness, that seems to be a persistent theme lately.
It does. And polls among strategists, they seem to confirm this. The expectation is for ongoing dollar weakness, and tied to that, future rate cuts from the Federal Reserve. So this kind of lower rate, weaker dollar environment really sets the stage for assets to flow elsewhere.
So you have the crypto momentum meeting these larger financial trends. Okay, let's track that flow. Who benefits first?
We can probably group the winners into, say, 3 buckets, all tied pretty directly to higher BTC prices or just more crypto activity overall.
Makes sense. Where do we start?
Let's start with the most direct leverage, the Bitcoin miners. We're talking companies like Marathon Digital, that's MRA, Riot Platforms, Riot, and CleanSpark, CLSK. When the price of Bitcoin goes up, these guys see, well, amplified returns.
Amplified how? It's more than just selling Bitcoin for a higher price.
Right. Oh, absolutely. It's about their operating leverage. See, their main costs, electricity, the specialized computers, the hardware, those are pretty much fixed, or at least predictable. So once Bitcoin's price moves above their break-even point, almost every extra dollar in price gain flows straight to their gross margin per hash. It expands dramatically.
Okay. So profitability shoots up fast.
Exactly. And that improves profitability. It helps their balance sheets, makes it easier and cheaper to fund expansion, buy more miners, that sort of thing.
Got it. That's a powerful dynamic in a rally. Okay, moving on from the miners. Where does all this trading happen? That must lead us to the exchanges.
Precisely. Category 2, exchanges and brokerages with crypto exposure. When crypto gets hot, volumes definitely go up.
More trading means more fees for them.
Yes. And it's kind of a double benefit for firms like Coinbase, Coin, and Robinhood. First, the direct transaction revenue.
Yeah.
Fees from spot trading, derivatives, even staking services they offer. But there's a second piece, maybe less obvious. It's the client balances.
You mean the cash people leave sitting in their accounts?
That's it. As more money flows into crypto, more cash sits idle on these platforms. The firms can earn yield on that float. So a sustained Bitcoin rally boosts both trading frequency and the amount of assets just sitting there. Both are good for their revenue.
Right. Miners, exchanges, what's the third group?
The third group is more on the infrastructure side, the ETF sponsors and custodians.
The institutional plumbing. How do they benefit? Is it just the value of the assets they hold going up?
Primarily, yes. Their income is often tied to assets under management, or AUM. They charge fees for servicing those assets, for custody. So as the price of Bitcoin rises, the value of the Bitcoin held in, say, an ETF goes up, AUM swells, and so do their fee revenues.
And does the weak dollar play in here too?
It does, actually. It reinforces that narrative of Bitcoin as a kind of digital hard asset, a hedge against currency devaluation. That story attracts more institutional money, more high net worth flows into regulated products like ETFs, which directly benefits the sponsors like BlackRock, that's BLK for their iShares Bitcoin Trust, and the custodians like BNY Mellon, BK, who provide the essential digital asset services.
Okay, so you have this whole ecosystem kind of lifting together miners, exchanges, infrastructure providers. But as you said, there's usually another side to the story. If money and attention are flowing this way, where are the pressures building up? Who's feeling the pinch?
Right, this is where those same macro factors, the weaker dollar, the rate cut expectations, start to create challenges for other types of businesses.
Let's take the weaker dollar first. You mentioned it helps miners, but who does it hurt?
It definitely creates headwinds for U.S. companies that rely heavily on imports. Think about the retail sector, particularly soft lines, clothing, shoes.
How does that work?
It's a direct currency translation issue. If the U.S. dollar weakens against, say, the currency in Vietnam or China, where they source goods, it costs them more dollars to buy the same amount of inventory. These are called landed costs.
So the cost of getting the goods onto the shelves goes up.
Exactly. The material points to companies like Nike, NKE, and Ross Stores, RST, as examples here. Now, if they can't pass that higher cost on to consumers right away, and that's tough, especially with holiday sales and promotions, then their gross margins get squeezed.
So their profitability is suddenly tied to foreign exchange rates, not just how much they sell.
Pretty much. It adds a layer of complexity and potential pressure.
Okay, that makes sense. What about the financial sector? You mentioned Bitcoin's rise puts a spotlight on the tech.
Yeah, and that could create some pressure for traditional remittance providers,
Mm,
companies like Western Union, WU, or Euronet Worldwide, EEFT.
because crypto offers an alternative for sending money.
Right. Think about sending money across borders. The old way involves correspondent banks. It can take days, and the fees can be, well, quite high sometimes. When Bitcoin rallies, people are reminded that there are alternatives, potentially using crypto rails, that can be much faster and cheaper, maybe near instant with very low fees.
So it's about the perceived competition.
It's partly that. The renewed focus on these faster, cheaper alternatives can weigh on how investors view the growth prospects, the multiples of the traditional players. They risk looking a bit slow or expensive by comparison.
Got it. And the last category of pressure comes back to interest rates, doesn't it? The Fed rate cut expectations.
It does. This impacts what we call interest income sensitive financials. These are firms, often banks or brokerages, that make a good chunk of their money from the difference between the interest they earn on loans and investments and the interest they pay out on deposits. That's the net interest margin, or NIM.
Okay, in. And lower rates are bad for NIM.
Generally, yes. When rates are expected to fall, as the polls and futures markets suggest, that spread, the NIM, tends to get compressed. They often have to lower the rates on their assets, like loans, faster than they can lower what they pay on deposits. That squeezes the margin.
And which companies feel this most?
The material highlights firms like Charles Schwab, SCHW, and Ally Financial, ALY, which have significant reliance on that interest spread and related income, like from cash sweeps.
So for you listening, putting this all together is key. You see how these two drivers, the crypto momentum and the dollar its picture, create this interconnected chain of effects. We can kind of boil this down to some core observations, right?
Yeah, I think so. If you're looking at potential opportunities based on this material, it points towards areas benefiting from the volatility in the activity flow. These are often momentum plays, maybe with higher beta to Bitcoin itself, specifically the miners we mentioned, Riot, CLSK.
And the exchanges and infrastructure plays too.
Right, the direct beneficiaries of activity, Coin and Hood. Yeah. And then the AUM or fee-based plays like BLK and BK. These are essentially bets on continued crypto strength and activity.
Okay, so those are the potential upsides. What about the areas where caution might be warranted, according to this analysis?
On the other side, the material suggests being mindful of the pressures from those same macro factors. So areas potentially facing headwinds. First, those FX-sensitive importers like NKE and Rost, especially if the dollar slide continues, their margins could be vulnerable.
And the financials sensitive to interest rates?
Correct. The NIM-sensitive firms like SCHW and LIY could face pressure if those predicted rate cuts actually happen and compress margins further.
You know, what really stands out from this whole analysis is how interconnected everything has become.
It really has.
An asset class like crypto isn't just in its own silo anymore. It's deeply tangled up with these big macroeconomic forces, central bank policy, currency movements. And that connection is now visibly impacting companies across totally different sectors, from, tech and mining all the way to traditional retail and banking.
That's a crucial takeaway. It's not just about who wins or loses from a Bitcoin rally today. It's that the dollar's direction and Fed expectations are now such central factors for, well, everything from tech valuations to retail profit margins. And maybe the thought to leave you with is this. If currency moves and rate expectations are dictating winners and losers so clearly across the board, does that mean perhaps that for a company like Nike, the Fed's policy direction might now be almost as important, or maybe even more important, than actual consumer demand for their products?
That's certainly something to think about. All right, that wraps up our look at the market impacts following Bitcoin's recent move. Thank you for joining us. And just a reminder, this information is not financial advice. It's not a recommendation to buy or sell any security. This discussion represents purely the opinion and analysis derived from the material we reviewed today.